Switzerland on the 21st of March became the first major economy to cut interest rates in 2024. This is soon followed by Sweden's central bank on the 8th of May, and then Canada on the 5th of June. On June 6th, the European Central Bank announced a 25 basis point interest rate cut. This is the first interest rate cut in Europe since 2019, as one of the three largest trade blocs in the world that is behind APEC and ahead of BRICS, and the most important trading partner of the U.S., the strategic significance of the European monetary policy reversal has deep implications in the global financial systems. With the European Central Bank's decision to cut interest rates, no matter how hard the U.S. Federal Reserve tries not to cut their interest rates or even attempts to hike its rates, they simply will not hold out for long. Why does the European Central Bank's interest rate cut have such a big impact on the U.S. Federal Reserve? It is because the U.S.-led global interest rate hikes is not something that U.S. Federal Reserve can manage alone on its own. Although the U.S. dollar is certainly the world's most dominant currency, it is not the only currency that is circulated around the world, let alone the only reserve currency in the world. The currencies of other developed countries also have their own spheres of influence. After the global pandemic from March 2022, U.S. hiked its benchmark rate 11 times to July 2023. The Fed funds rate has not been cut since then. This has resulted to the flow of U.S. dollars globally back within U.S. shores, causing depletion of the U.S. dollars outside of the U.S. As the supply of U.S. dollars dries up, countries had to fork out more reserves to buy up the remaining U.S. dollars available, eventually crippling the financial and economic systems of these countries, plunging them into financial crisis. Overnight, their assets will be steeply devalued. When this happens, the U.S. will then come in to buy up their devalued assets. Now, for this to happen effectively at the lowest cost to U.S., it is necessary for the other major world reserve currencies around the world to raise interest rates together so as not to leave alternative currency options available on the table. This is akin to the analogy of pumping water out from a tank. The more pumps there are, the quicker you get the job done draining out water from the tank. Among the other major world reserve currencies, Euro is the next most commonly traded currency behind US dollars. Now that the European Central Bank begins to cut interest rates together with Switzerland, Sweden, and Canada, they're setting up the stage for the other Western economies to follow suit in the policy reversal. This will spark a reversal in global capital flows, leading to the release of liquidity of the world reserve currencies back to the global markets again. When this happens, the countries that were struggling under the rate hike cycle would have their funding crunch situation alleviated. Of course, we need to bear in mind that the U.S. Federal Reserve hasn't cut interest rates yet. But we do know that the U.S. economy is also struggling to keep its head above the water during these times of high interest rates, and it's getting more and more unsustainable for them. When financial flows to other countries are eased, this means that the United States can no longer easily purchase devalued assets of other economies through manipulation of global U.S. dollar flows. Even if the U.S. Federal Reserve is to continue and stay on its current course to maintain or even increase its interest rates now and drain out all the water from the tank on its own anyway, it will need to consider two possible risks. First, its domestic economy is already struggling under the current high-interest environment. The current social issues may potentially result to unrest and protest. This is something that the current administration cannot afford to have, especially with the election around the corner later this year. Next, the pace of the dollarization globally will accelerate. In the current state of international trade, people are desperate for alternatives to the costly US dollar. As the European Central Bank begins to cut its rates, euro will potentially become this alternative that people are looking for. After all, the euro has long been the second most widely used currency as foreign exchange reserve, standing at 20% composition in 2023. US dollar is first standing at 58.4% during the same period. This is the significance of the euro interest rate cut. Although this cannot be regarded as the inflection point of the entire global monetary cycle and financial wars, it is certainly an important forward-looking indication for the things to come. After the euro is reversed its monetary policy, it is unlikely that the dollar will continue with its high interest rates for long. So why does the European Central Bank decide to cut its interest rates? To put it simply, the Eurozone no longer have the means to maintain the current high levels of interest rates. The rate on its marginal lending before the cut stands at 4.5%. The European economy has been very bad over the past 2 years. But still, in its dire state, Europe had been forced by the United States to carry out its interest rate hikes. They had to increase interest rates partly to limit the flow of global funds out of Europe in tandem with US Federal Reserve. However, interest rate hike is a double-edged sword. It suppresses the Eurozone economy, pushing it to the verge of collapsing. Should the US Federal Reserve succeed in crashing the other global weaker economies like China, Europe can follow US and take over the devalued assets of the crashed economies, thereby making up for the losses that they suffered during the high interest rate periods. However, it has already been 2 years since the interest rate hikes began, and the major and lucrative economies like China have still not collapsed. China's exchange rate remains stable at 7.2. Foreign exchange reserves are stable at 3.0 trillion. At the level, the Chinese government still has a lot of surplus to buy into gold using their foreign exchange reserve. China has also been exchanging renminbi with emerging countries to help relieve them from the financial stress during this period. As a result, Europe had to struggle with the side effects coming from interest rate hikes in Eurozone. Not only are they encountering pressures within their own financial systems, they are getting a hit in their manufacturing industries while battling inflation at the same time. Hence, Eurozone has to cut interest rates as a means to save themselves. At least this can reduce the cost of operation within their own economies. There are risks inherent to the cutting of interest rates at this point. Please check out my next video on this topic. Thank you.